Wonder how to become a profitable stock market trader in just 30 days? Well, let's embark on this exciting journey together. Stock market trading at its core is the practice of buying and selling stocks, pieces of ownership in a company. Imagine it as a bustling marketplace where traders gather to buy and sell these pieces of ownership. The objective? To buy low and sell high, turning a profit in the process. Sounds simple, right? But don't be fooled. There's more than meets the eye. Now you might ask, why trade stocks? Well, stock trading can be a lucrative practice, offering financial freedom and the potential to build significant wealth over time. It's like a game of chess. With the right moves, you can win big. But remember, every game has its risks. The stock market is dynamic and unpredictable. Prices of stocks fluctuate based on a myriad of factors, from economic indicators to company performance to geopolitical events. So while the rewards can be high, the risks are equally significant. One wrong move can lead to substantial losses, but don't let that deter you. With the right knowledge and strategy, these risks can be managed. That's where we come in. Over the next few scenes, we'll guide you through the labyrinth of the stock market. We'll help you understand what drives prices, how to analyze the market, and develop a trading strategy. We'll also delve into the practical aspect, making your first trade. And remember, no one gets it right the first time. It's a process of continuous learning, reviewing, and improving. So, are you ready to take control of your financial future, to navigate the highs and lows of the stock market with confidence? Buckle up, because it's going to be an exciting ride. Now that you have a basic understanding of stock trading, let's dive into how you can become a profitable trader in just 30 days. Before you can start trading, it's crucial to understand how the stock market works. Think of the stock market as a giant global marketplace where shares of publicly traded companies are bought and sold. These shares represent a piece of ownership in a company, and investors buy them with the hope that the company will perform well and increase in value over time. Now, let's break down some basic terminology. A stock is essentially a slice of a company that you can buy. When you own a stock, you own a piece of that company, and you're often referred to as a shareholder. A share, on the other hand, is the single smallest denomination of a company's stock. So, if a company has 1,000 shares of stock outstanding, and you own 50, you own 5% of the company, next up is dividend. This is a portion of the company's profits that is distributed to shareholders, usually on a regular basis. Not all companies pay dividends, especially those in growth phases. They may instead reinvest their profits back into the business to fuel further growth. Then we have capital gains. This is the profit you make when you sell a stock for more than you bought it for. The difference between the purchase price and the sale price is your capital gain. But remember, if you sell a stock for less than you bought it for, that's a capital loss. The stock market operates much like an auction house. Buyers and sellers negotiate prices and make trades. The price of each stock is determined by the supply and demand in the market. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. In essence, the stock market is a platform for the exchange of securities between buyers and sellers, creating a competitive and dynamic environment. With this knowledge, you're now ready to start exploring the strategies to become a profitable trader. A successful trader always has a well-planned strategy. This is a golden rule in the world of trading. Without a strategy, it's like sailing a ship without a compass. You're at the mercy of the winds, and you're likely to end up somewhere you never intended to be. So let's dive into the importance of having a trading strategy. A strategy is your roadmap, your blueprint. It not only guides your decisions, but helps you stay disciplined and consistent. It's your shield against impulsive decisions that could potentially lead to losses. There are many types of trading strategies out there, and each one suits different types of traders, depending on their goals, risk tolerance, and time commitment. Firstly, we have the buy and hold strategy. This is a passive strategy where you buy stocks and hold onto them for a long time, regardless of market fluctuations. It's based on the belief that over time the stock market will provide a good rate of return despite periods of volatility. Next, we have market timing. This strategy is about buying and selling stocks based on predictive methods for price direction. Traders using this strategy believe they can beat the market by predicting its movements. Then there's momentum trading. Here, traders focus on stocks that are moving in one particular direction with a significant amount of volume. They believe in the saying, "The trend is your friend," and they aim to capitalize on that momentum. These are just a few examples. There are a myriad of strategies out there, from swing trading to position trading, scalping, and more. Each has its own set of rules and methods and its own pros and cons. Choosing the right strategy requires careful consideration. You need to align it with your financial goals, risk tolerance, and the time you can commit to trading. Remember, a trading strategy is not a one-size-fits-all solution. It needs to be tailored to you, your goals, and your circumstances. Remember, a good strategy is the backbone of successful trading. So take the time to develop yours and let it guide you on your journey to becoming a successful trader. Market analysis is a key step in your trading journey. So let's delve into why it's such an essential component. At its core, market analysis is about understanding the forces that drive the market. I'm sure you've heard the saying, knowledge is power. It's especially true in the stock market. The more you know, the better your chances of making a profitable trade. There are two main types of market analysis, fundamental and technical. Let's start with fundamental analysis. This is all about evaluating a company's intrinsic value. It's like being a detective, piecing together clues about a company's financial health. You'll look at things like a company's earnings, its debt, and its growth prospects. The goal is to determine whether a company's stock is undervalued or overvalued. If a stock is undervalued, it might be a good time to buy. If it's overvalued, it might be a good time to sell. Now, let's talk about technical analysis. This is a different beast altogether. Instead of looking at a company's fundamentals, technical analysis focuses on price movements and trading volume. The idea is that price patterns and trends can help predict future price movements. To do this, technical analysts use a variety of tools and charts. It's like trying to read the stock market's tea leaves. Both fundamental and technical analysis have their strengths. Fundamental analysis can help you find stocks that are a good long-term investment. Technical analysis, on the other hand, can help you time your trades to maximize profit. But remember, no form of analysis can guarantee a successful trade. The stock market is influenced by a multitude of factors. However, by understanding these two forms of analysis, you equip yourself with tools to make informed trading decisions. The key is to be diligent. Take your time to analyze the market. Don't rush your decisions. Remember, patience is a trader's best friend. With diligent analysis, you'll be able to make smart trading decisions. And that, my friends, is how you turn knowledge into power in the stock market. So, keep learning, keep analyzing, and most importantly, keep trading. Now that you're equipped with knowledge and strategy, it's time to make your first trade. This is the moment where theory meets practice, and it's a thrilling experience. But before diving in, let's break down the process to make it manageable and clear. First things first, you need to set a budget. Trading in the stock market isn't about making a quick buck. It's about investing wisely and responsibly. Setting a budget not only helps manage risk, but also gives you a clear picture of what you can afford to invest and potentially lose. Remember, the stock market can be unpredictable. Next, it's time to choose the right stock. This decision should be based on thorough research and analysis, not on whims or trends. Consider factors like the company's financial health, its competitive position, and the overall market conditions. Pay close attention to the company's earnings reports and any news that might impact its stock price. Once you've chosen a stock, it's time to place an order. This involves deciding how many shares you want to buy and at what price. You can place a market order, which buys the stock at its current price, or a limit order, which buys the stock only if it reaches a certain price. It's crucial to understand the difference between these order types, as each has its own risks and benefits. After placing your order, it's important to monitor the trade. The stock market is dynamic and can change in the blink of an eye. Regularly check on your investments and be ready to make adjustments as necessary. This doesn't mean you need to watch the market every second of the day, but a periodic review can help you stay on top of things. Congratulations! You've just made your first step towards becoming a profitable trader. Remember, every successful trader was once a beginner, so keep learning, stay patient, and most importantly, enjoy the journey. The journey of a trader is a continuous process of learning and improving. And this journey doesn't end with making your first trade. In fact, it's just the beginning. The stock market is a dynamic environment. It changes every day, every hour, every minute, even every second. And as the market changes, so too must your trading strategy. This is why it's essential to regularly review your trading performance and refine your strategy based on these reviews. Think of your trading strategy as a roadmap. It guides your trading decisions, steering you towards profitability. But what happens when the landscape changes? When the roads you've mapped out are no longer there or new ones have appeared, you need to update your map. And in the world of stock trading, this means refining your strategy. So, how do you review your trading performance? It's a combination of looking at your profits and losses, of course, but also analyzing your decision-making process. Were your trades based on sound analysis or were they impulsive? Did you stick to your plan or deviate from it? These are the questions you need to ask yourself. And don't be afraid of mistakes. They're an inevitable part of trading. What's important is not the mistake itself, but what you learn from it. Every mistake is an opportunity to improve, to refine your strategy, to become a better trader. Moreover, it's important to remember that the market is not your enemy. It's a vast, complex system that simply reacts to a myriad of factors. Understanding this can help you avoid personalizing losses, which can cloud your judgment and hinder your ability to review your performance objectively. Reviewing your performance and refining your strategy is not a one-time event. It's a continuous process, a cycle of learning and improving. It's what separates the successful traders from the rest. It's what will help you become a profitable trader in just 30 days. Remember, consistent review and improvement is the key to becoming a profitable trader in just 30 days. Because in the world of stock trading, those who stop learning, stop earning. Becoming a profitable trader is no overnight success. It's a journey that begins with understanding the stock market, its dynamics, and its various components. It's about learning to read the signs, to interpret the trends, to make sense of the numbers. It's about developing a trading strategy that fits your goals and risk tolerance. Then, putting that strategy into action with your first trade. The most important part of this journey is the review and improvement stage. It's about learning from your successes and failures, tweaking your strategy, and continuously improving. It's about patience and persistence, because the stock market is not a get-rich-quick scheme. It's about continuous learning, because the stock market is always evolving, always changing. Remember, the key to becoming a profitable trader is not about making the right trades every time. It's about making more right trades over time. With the right approach and mindset, you can become a profitable stock market trader in just 30 days. Happy trading!